Well, good morning and a warm welcome to everybody attending today's webinar about contractor insolvency mitigations. I must say, what an incredible turnout today. It's been fantastic to see how much sector interest there is in this particular topic. I guess given the latest insolvency numbers, which we'll see shortly, we perhaps shouldn't be surprised about the levels of anxiety that exist right now. After all, we all have a shared interest in addressing the challenges that we face, and ultimately we all want to deliver and build greater resilience in a fantastic construction sector that we work in. So we've got a packed agenda today. Stay tuned, and if you do need to revisit anything that we discussed today, the webinar is going to be recorded and it will be accessible after the event. We'll also have time for a Q&A at the end of today's session. So you'll see it at the top of the screen, or depending on the layout, it might be at the side, but there should be a Q&A button. Please use that to submit any questions, and we'll collate those, and our panel will do the best we can to answer those at the end of today's session. So for those who don't know Miller, BDO, or today's speakers, we'll briefly introduce ourselves to you. So Miller has been operating as a broker for 120 years, and we've got over 700 colleagues. And we're all about specialisms and being industry leaders in those. Very topically, for example, with the World Cup currently underway, our sports specialists lead the football sector, and they represent over half the England football squad. Of course, another of our specialisms critical today is construction. And with over 25 colleagues, our construction team lead the sector as the sole appointed risk and insurance advisory member of Build UK. And as the risks in construction escalate, we continue to see organisations turn to Miller to help de-risk their business and their projects. So let's introduce today's speakers as well, and our webinar partner today, BDO. I'm Jason Baston. I'm an expert in construction risks and the insurance solutions to those. And I've been working in property and casualty risks for over 20 years. Sally, Nick, if you'd like to introduce yourselves.
Sure. Good morning, everyone. My name is Sally Hinchy, and I am head of surety practice for Miller. I've been specialised in surety for the last 15 years or so, and find it a very enjoyable experience.
Thanks, Sally. Good morning, everyone. My name is Nick Eggert. I'm a supply chain and logistics risk specialist within BDO. I have 20 odd years of experience as a practitioner, having managed vehicle fleets, distribution centres, done strategic inventory management. I'm also a qualified accountant and I've done project management and have worked with clients over the last 5 or 6 years across a range of sectors, advising on supplier, supply chain, procurement, spend analysis, and all elements of risk involved within that. In terms of BDO, we as a firm are based internationally. We have over 160 offices internationally and have nearly 100,000 employees internationally. In the UK, we have 17 offices in England, Scotland, and Northern Ireland, and 7,000 employees. We provide a range of services, as it says on the screen there, primarily audit. Likely we're best known for that, but other elements of our business include tax and advisory. And within the advisory stream, we work with clients on mergers and acquisitions. We provide outsourcing services on payroll and things of that nature. We provide risk advisory services, forensics, valuations, business recovery, perhaps pertinent to this topic. And value creation services. So yeah, a wide range of services we can offer and support a great deal of sectors and clients, and are very active in the construction sector.
Fantastic. Thank you, Sally. Thank you, Nick. Much appreciated. Okay, so let's take a look at the agenda for today's webinar. We're going to begin with a look at what's happening in the sector, the insolvency concerns and the challenges that are being faced. We'll move on then to have a look at why that actually matters, the stakeholders that are on today's call, and ultimately we're then going to move on and look at the most critical piece today, the focus on insolvency risk mitigation, the measures that can help to substantially reduce the impact of insolvency risk in your business. And we'll then finish off today with a Q&A session. Okay, let's get started. So a bit of a stark visual there, and I'll let you just absorb that to begin with, because construction is inherently a very high risk industry. Anything undergoing change is ultimately high risk compared to static property. And that high risk in construction is evident in multiple data sets. Many on the call will be aware that sadly, construction continues to have the highest fatality rate of all UK sectors, as well as high frequency, high severity losses to property under construction. But what we've got now is insolvency being added as a major project risk. And what we've got on screen is the latest data from the Insolvency Service. And that really gives a stark message. Construction was already the biggest sector when it comes to insolvency in the UK. But look at how those numbers have evolved. The rates have doubled in just the past 12 months. And the data shows that that continues to escalate. So we are facing a severe risk factor now of insolvency in our sector. So not only are employers and others in the supply chain exposed as potential unsecured creditors, but it's actually now a huge headache for anybody who has to deal with the wider impact and the fallout. You might be wondering, why are those numbers so severe? Well, we've only got to look back a few years. The legacy of COVID is still out there. And sorry, I did mention COVID. It does feature, of course, a lot. But, you know, let's be realistic here. Companies have not had a chance to catch up, and their balance sheets are still struggling to recover in many parts of the construction sector. But we've then got current and future cash flow vulnerabilities that continue to play out. We see price-focused tenders driving very thin margins on the works. There's this enormous time delay from the point of tender. There might be a delayed investment. Works finally get underway. And then through that works package and the completion of those works, there might be a period there between 3 to 5 years or more. And of course, we all know how much can change in that time. We've seen substantial inflation on materials, labour costs, but of course, with a low use of fluctuation provisions in contracts, those mitigations that might exist are not necessarily always there, and that's putting additional pressure on the chain. Retentions, payments of liquidated damages, they all take that cash back out of the system temporarily. And then we've had supply chain issues, of course, and Nick is going to talk us through those in more detail, but we're all aware, we've seen it in the press, the availability of materials, suppliers, the challenges of subcontractors, some of whom have gone under already. And that domino effect up and down the supply chain is a real feature now in the risk for any project. So let's move on and have a look at the impact on the stakeholders. As we mentioned, construction is an incredibly high risk activity. With those high frequency, high severity losses, you combine that with multi-million pound assets, and you've got a very dangerous risk cocktail that everybody has to navigate. So for employers, contractors, and all the stakeholders, the uncertainty that that risk profile creates for the balance sheet is a real challenge to navigate, and particularly right now when the risks are evolving so rapidly. So what we're seeing is that when contractors and suppliers are failing to navigate those risks and they can't stay afloat any longer, the insolvency that then becomes can be far-reaching as an impact for all stakeholders. Firstly, the assets that have been developed on any given project become enormously exposed. As we regularly see, once a contractor is declared insolvent, the project site will typically be vacated, the gates are going to be locked temporarily, site security is likely to have departed too, having been unpaid. So we've got a partially completed project, very often a multi-million pound asset, let's face it. And that's enormously now exposed to numerous perils, arson, theft, malicious damage, not to mention weather and storm events, particularly at this time of year. So a huge danger exists, because if something were to happen to that site and that project, it's likely going to be left unchecked for some time, and that site is at risk of destruction. Worse still, the insurances that might have been provided by that insolvent party have now become ineffective. So you've got this asset enormously exposed, multi-million pounds, uninsured at the most critical time. And if that site then becomes damaged or destroyed, the owner or investor of that particular asset may not have the balance sheet either and the resilience to meet those losses. As Nick's going to elaborate on, there are the well-reported domino effects of unpaid subcontractors, suppliers, and those other unsecured creditors. And finally, of course, there may be some contractual step-in rights that might enable some continuation of the works, but ultimately it's normal for a formal cessation of works to occur whilst a replacement contractor is going to be tendered for. So as a result, that remaining project is going to face many additional challenges. There'll be a delay to practical completion. There'll be an increased contract value in all likelihood, which will need to be financed. There's going to be an exclusion for any defects associated with the prior contractor's works, and that may result in difficulty obtaining structural warranties. We're also likely to see, as a result of a delay in PC date, that there's going to be a delay to future revenue streams, and that might have underpinned the original investment decision, particularly for things like student accommodation or anything that's due to drive a revenue at the end. And furthermore, there's additional costs to consider as well, debt servicing or provision of alternative accommodation, for example. So the implications of insolvency on all stakeholders are, let's face it, very widespread and substantial. So let's move on and have a look at the critical recommendations that we feature in today's webinar. And the first of those 5 is to seek expert risk advice as soon as you possibly can. As an employer, at the pre-construction project stage, that ensures the right path can be taken at the very outset and your project risks can be considered most fully. As a contractor, as a subcontractor, or as a supplier, at each tender it should be considered, but also at organisational level as soon as possible. And that's because ultimately it's crucial to assess your business appetite for risk versus reward. You may be in the construction business, you might be in the contracting business, but ask yourself, are you in the risk business? And seek support from those risk experts to evaluate how you can develop a resilient risk strategy that's going to best protect your balance sheet according to your business needs. For example, you might think about your contracting approach and which one is actually going to be right for you going forwards, despite what you might have done historically. As an organisation, how much risk do you want to retain on a particular project or as an organisation? Where and how do you want to mitigate the risks that you face as a business? And where might you want to transact your risk to? And that transaction of risk can take many forms. And then ultimately, when you've designed your strategy, how are you going to implement that? How are you going to govern and manage the implementation of that strategy throughout your business? Because construction is such a high risk sector, the engagement of that risk expertise is going to be highly cost effective, and it's going to drive savings, and it's going to reduce the total cost of risk in your business. Now, our second recommendation is critical, and that's that it's essential to have a robust insurance approach. So if you're implementing your risk strategy that we talked about in that first recommendation, and if you're to rely on the insurance programme to protect your balance sheet should the worst happen, you need to know that that programme is robust, it's fully understood, and it's actually going to operate when you need it most. For example, how will your insurance programme operate in the event of insolvency? And on a particular project, who is going to be exposed? Main additional burden if one of their key subcontractors or somebody in their supply chain who might have assumed insurance responsibilities becomes insolvent. Another example is that the employer could be left exposed if their main contractor becomes insolvent and their asset is uninsured. So in these instances, it's always worth considering a project-specific owner control policy that's going to protect everybody and wrap around the whole project. A robust joint names project insurance taken out by the employer is going to continue to operate, and it's going to protect all parties to that project, even if the contractor changes due to insolvency. And then we look at our third recommendation, and that's to consider protection for those future latent structural defects that might emerge. Now, as we know, defect liability typically lasts for 6 or 12 years in contract. But what happens when the contractor becomes insolvent and can't discharge its post-completion obligations? Of course, none of us have that crystal ball to see into the future. And so we need to be thinking about these particular risks. And that is, of course, given the rise in insolvency, now a critical thing to consider on any project. So latent defect insurance is becoming increasingly popular for those reasons, with property owners, developers, and parties embarking on new projects right now. That would effectively indemnify the owner for damage to the structure of the building and the building envelope from future construction defects that emerge. So those are our first 3 recommendations today. I'm delighted to now pass over to Sally and to Nick as well, who will discuss our 4th and 5th recommendations. Over to you, Sally. Thank you.
Thank you, Jason. Some very insightful, thought-provoking points there that you raised. So, good morning, everyone. Again, sorry. So, when we talk surety bonds, what is a performance bond? So, in its simplest form, a surety bond is a guarantee provided from one party in favour of another to guarantee the due performance of an obligation. In the construction sector, bonds are typically provided by contractors in favour of employees to guarantee performance under the construction contract. The bond is a financial instrument providing compensation for damages suffered by the beneficiary, who's the employer, in the event of non-performance of the contract by the principal of the contractor. Next slide, please. Typically, we see that performance of surety bonds are provided by financially rated insurance companies. And this is important because the financial credit worthiness of the party providing the guarantee in favour of the contractor is an important point to note, because we do often see a lot of unrated markets providing bonds to contractors. And in that worst case scenario of a claim situation, their paper can be considered worthless. So it's always important to consider the financial standard of the insurance company of which the bond paper is issued from. The cost of surety bonds we see typically is met by the employer. And in terms of bond value, the normal market practice is that we see liability in the bond capped at 10% of the contract price. Now, a point to factor in is the availability and cost of capacity to the contractor is based upon their financial creditworthiness. So whilst the provision of a surety bond may come at a cost to the employer, the key points to note are for the employer is that they can take comfort from the financial standing of the insurance company, as I've already mentioned, acting as a third-party guarantor on behalf of the contractor. And the availability of capacity of a contractor carries a lot of weight for a contractor, as it's considered an enhancement of their balance sheet strength. This is due to the rigorous underwriting process undergone in order to secure bond capacity in the first instance. For those who read the Construction Inquirer, they may have seen an article regarding T. Clark over the last week or so, which basically shows that their strong standing in the bond market has helped them position themselves for growth and positioned themselves strongly against their industry peers. In contrast to a surety bond is the provision of parent company guarantees, which I'm sure is a term everyone is familiar with. And essentially, that's a conditional promise by a parent company to answer to a third party for the debt or default of its subsidiary. Upon first consideration, a PCG in lieu of a surety bond may be a favourable option. It could be cheaper if the parent company doesn't charge a fee for providing the PCG. The protection may be broader and of greater duration. and it also may not contain a financial cap on damages. All sounds good and all P is in order, but let's have a thought around putting the PCG into play in the event of a default. Under a surety bond, the surety has responsibility to independently investigate the claim. Whilst the defences afforded under the contract are available to the surety, the parties can expect the surety to act in good faith in response to any claim situation. Under the PCG, the defences under the contract are likewise available to the parent. However, the parent of the defaulted subsidiary in a contested default, for example, may not have the same independent response or obligations of good faith in its review and investigation, potentially diminishing the security afforded under the PCG. Of a wider concern and of utmost importance as well, in that worst case scenario of an insolvency event of either the bonded subsidiary or the parent company itself, it's in absolute important to assess the credit worthiness of the parent and the group of the parent as a whole, not only at the point of entering into the contract and issuance of any PCG, but an ongoing monitoring basis. The parent company may hold sufficient assets at the point of providing the PCG, but without specific covenants, such assets can be transferred within a corporate group. So at the point of we providing parent company guarantees, whilst an assessment may be carried on, but what monitoring controls are in place to ensure that that credit worthiness stands through the duration of the contract of utmost importance. Next slide, please. So when we talk surety and the key takeaways really in comparison to parent company guarantees, the parent company guarantees you could consider provides little or no security in the event that affects the entire group and the entire financial standing of the group. And it's not uncommon to see requests for both parent company guarantees and performance bonds. And these are typically requested at tender stage. And it's always a good opportunity to evaluate what is the right course of action and play out that role of how in that claim scenario that would be processed and how it would be dealt with. And again, just picking up on that ultimate important point there, the robust financial due diligence of key importance, not only at contract stage, but throughout the duration of the contract and how that's going to be monitored. And after that, I'll pass on to Nick.
Thank you very much, Sally. Good morning again, everyone. So this part is essentially going to address some of the topics that Jason mentioned in his part of the webinar. And really what I want to do to set the scene is ask you to think about the language we use, when we are talking about how we perceive issues that we deal with. So nip it in the bud, prevention is better than the cure. That kind of language is what we use, but all too often that's not applied to the business world. So if we can have the next slide, please. So as part of this, and we'll go on to talk about and flesh out the sort of the supplier risk, supply chain risk sort of approach that we recommend and work with our clients often to deliver. So in terms of supply chain practitioner, and I'm very much coming at it from that perspective, I thought it'd be good just to lay out some of the considerations that I think about when I'm working with clients in this sector. So margins will be tight. I think that's a commonly understood issue, and they're getting squeezed with everything. The macroeconomic situation, price of steel is going up. There is scarcity of resource. There have been shipping issues with the Evergreen ship blocking the Suez, COVID, and so on. So those are all things that impact this sector. Optimism bias. Everyone thinks they can do things quickly, on time, to budget, to quality, and that's something we need to factor in, or I factor in when thinking about supply chain issues in this sector. Delays will occur. So there are three certainties in life: death, taxes, and the fact that your supply chain will experience a disruption. Now, death is fairly absolute, but supply chain disruptions can be relative. We're talking about insolvency here, but we want to provide the framework and the ability to avoid that outcome, but it's going to happen. The nature of the sector, we have you have a project path, you have a deadline, you have things that need to be hit, and so in other sectors perhaps there is ability to react and recover and still deliver the output to the customer. That's perhaps not as applicable here, and we've seen the rates of insolvency in this sector are high and are the highest in all the sectors, so these are the conditions that we're talking about, and I think about when I'm doing supply chain. In terms of wider trends that will be, I suspect, applicable to this sector, and the trends on the right hand side, they're not good practice. These are things we see in pretty much every customer we work with, and I've experienced in my own working life. So what we tend to have is when we're going out to market to get a supplier, we do the tendering, we do the mechanics of the tendering well in the main, but it tends to be a procurement business in isolation from the rest of the organisation, often lacks sufficient detail for the customer to respond, or the contractor to respond with confidence, and so we get off to a bad start. When we do in the risk assessments, it tends to be very much, if it's done at all, it's a credit check, which isn't particularly useful. Often we see that when we're trying to assess and categorize risk exposure from our suppliers, that where we get where we think we spend the most money, that's where our highest risk sits, and that's not always the case, and we'll talk about that a bit later. Due diligence, as I've said, limited to a credit check. Often when we get the contract, we forget about it. We sign the contract and that gets stuck in a drawer somewhere, and that doesn't then translate into business activity or operational management. When we are sort of trying to respond to an incident, it's often because we haven't done any thinking or planning up front as to what the risk might be, how we might be notified of those risks, or that risk materialising, and therefore we're reacting and sort of behind the curve at the very beginning. So if we can have the next slide, please, Vanessa. So these are some of the underpinning principles that I apply when working on this matter. So plans have limited use. So planning is invaluable, but plans have limited use. We talked about up front, Jason mentioned about establishing a risk appetite, thinking about your strategy, your risk appetite, what you're going to tolerate, how you're going to do that. Planning is part of that. We sometimes make it a cottage industry, but it's better to have thought about it and mentally rehearsed it, at least, because you've thought about scenarios, you've thought about the what if. And if you have a plan, you can adapt a plan rather than trying to create a plan from the beginning. And that moves on to sort of the next sector. No plan survives contact, for the military historians of you amongst you. That was coined, not exactly like that, by a gentleman called Helmuth von Moltke the Elder, a Prussian general from the 19th century. But that just means you can plan for everything, but no situation is going to be exactly like the scenario you've planned for. And so you're adapting it. Moving on to the ability to react. So it's a bit Darwinian, this. I know supply chain doesn't often reference Darwin, but it's not necessarily survival of the fittest. It's those organisations who are best able to adapt and react to the situation that can prosper or are more likely to prosper. So that's about giving yourself enough time to react, giving you that thinking time. Right, what is this? Where do we need to go? What is the outcome we want? And so it's that early warnings thing that we need to think about. And then trust is not an effective management tool, and it's not all too often. We go, okay, we've outsourced our risk management to a subcontractor. They're managing it on behalf, and we are relying on them. We're not getting the feedback from them. Well, yeah, you can outsource the management exercise, but when a risk materializes, it will still flow to you as the prime contractor. Great example of this from the Army. In fact, they outsourced recruitment to a well-known outsourcing company. That company made a number of assumptions that were found to be erroneous, and so the Army was not able to satisfy its recruiting criteria for 2 years, and in the Army that created a staff black hole that couldn't be filled. So it's important to trust, but it's also important to verify and make sure and take active decisions, if that makes sense. So if we can have the next slide, please. And this this slide really is trying to encapsulate what Jason was talking about in terms of creating a structure, developing a strategy, putting your processes in place. And this can be applied to a single project. It can be chunked up to be a company level framework, or it can chunk down to subcontract work streams and what have you. So just to explain it, so supply planning and contracting, this is kind of a life cycle. So this is the pre-contracting, going to market, procurement bit, where we're setting the conditions to manage our supply chain. Now, supply resilience planning, that is the thinking about what might go wrong, the what if scenario, how well placed are we to respond to an issue that materializes or happens, and then get back onto an even keel. And then we're talking about, once we've done all that, the business as usual, putting the contract, the operational activity, and managing that as part of the day-to-day business. The supply resilience planning happens at the beginning, happens throughout, and should be happening right up until the sort of closure of the project or the build or whatever environment and scenario we're in. So if we can just build the slide, please, Vanessa. Okay, so in terms of risk areas, these are some areas that we want to think about, but when we're thinking about them and considering, we want to think about internally. So the people, process, technology internally to our organisation. We want to think about it in context of our supply chain and our suppliers. We want to think about it in terms of our customers. We want to think about it in terms of the international environment, the macroeconomic situation. So just picking up materials, we've talked about materials. So again, price of steel is going through the roof. There's been shortages of other materials. So what does that mean for us? What does that mean for a supplier? Who are we relying on to provide those materials for us? Are there certain things that we can do without? Sorry, so scarce resource. So again, just perhaps an example of that, Network Rail almost came to a shuddering halt a few years ago because the paper manufacturer that produced the ticket or the paper for the tickets, there was only one of them in Germany. They were looking at going bust. And there was no immediate replacement. So again, trains, we talk about engineering, we talk about drivers, we talk about paying conditions, but we didn't necessarily consider that paper might have stopped the rail network potentially a few years ago. Next element of the slide, please. So this in terms of where we're sort of going to market, setting the conditions, bringing a supplier into our sort of control and agreeing to work with them. These are just some of the things that we want to talk about, but it's about setting the conditions. It's about developing understanding. It's about making sure that we know in detail or sufficient detail what's going on and how that we're making the right decision to work with this supplier and this subcontractor or partner or whoever it is. And there are obvious things on there, but perhaps the one thing I would highlight is financial due diligence. That's critical. Often, if it's done, it looks at historic accounts. They can hide things. We want to be looking at forward-looking projections. We want to be looking at order books. We want to see if you're the only contract that this business or this subcontractor has. We want to be looking at their debt levels when they're due to mature. We want to look into deep dive into their tender, their proposition to you. And just to sort of bring this to life, our business recovery team was asked to conduct due diligence of a number of subcontractors by a prime. They carried out similar sort of due diligence on a wide variety of areas and identified that one of the subbies had forecast a 1% profit on their pitch. that job was going to be important, was going to be the thing that kept them afloat until the next job arrived. There was issues with debt, there was all kinds of things going on, and as a result, the prime opted not to work with them. But then this is about setting the conditions, identifying what you know, and identifying your skills gaps and things like that. Next part of the slide, please. In terms of supply chain resilience planning, again, this is going to happen. So it's just how quickly you can react. And this is about setting the conditions and getting the early warning so that you can enact your plan. But it's important to understand what they might be. So it could be a forecast from a supplier is out with the thresholds you've set. So you need to start monitoring that. And then there might be another trigger. But also when you're managing risk often has an accompanying budget and a contingency. You know, risks might be live. There might be a period where that risk is now finished, we're satisfied with that risk, and so we can release the contingency budget to other pieces of work so that it can help manage that. It's also good to understand what you do know and what support you might need, and it's better to ask early than it is to wait till and try and sort it out yourself. And we've seen scenarios over the years with sort of major frauds and where not frauds, that's the wrong word, but major sort of failures of business, Carillion being the most obvious example, where there's sort of there's always been this optimism that we'll be able to muddle through to the next one and it'll be all right. But actually, sometimes it's best just to put your hands up and ask for help. And the next build, please, Vanessa. And this part is once we've done the contracting, we've got the contract in place, we understand our performance indicators, we know how we're going to react in the event of something going wrong, we know what our indicators and triggers are. This is about transitioning now and being active in managing this, working with the suppliers, working with the team within the business, making sure that everyone has the right skills to fulfill their part in the management cycle and understanding how the suppliers are, developing those relationships so that you can have open and honest conversations and sharing the right level of information. And on this side, I would say perhaps the thing I would bring to people's attention is if you've got the right to audit, exercise it right. And that might not be a formal audit clipboard and everything, but it's a chance to just look at things within the organisation, to do that confirmation, to make sure that you're not relying on trust and the word of people. And next part, please, Vanessa. But the important thing is as well, I know there are companies of various sizes in the audience. This has to be proportionate, it has to work for you, but that goes back to the initial risk assessment. What risk are you exposed to? Who is the most important or the highest risk client? What is the highest risk area? And you focus your effort on there. And that I think is key as well. You don't want to be spending resource turning this into an industry in and of itself, but it has to be right for you so that you can avoid the insolvency outcome and get support when you need it. And that's completes my slides. Vanessa, thank you.
Thank you everyone for your insights. We do have a couple of questions in the Q&A function, but just to remind the audience that if you do have a question you'd like to put towards our panel, then please do use the Q&A function and we will run through them with our panel speakers. So to kick things off, we have a question that says, we've got subcontractors who take the risk and provide us with a certificate of insurance as evidence for their renewal each year. Should we be doing more to protect ourselves?
Shall I take that?
Yeah.
Jason, after you.
Yeah, I'm happy to take that one. That's fine. Thanks, Nick. I guess the first thing is to understand and consider as a business how you want to allocate risk, and ultimately every business right now needs to be thinking about how they de-risk themselves as a business. But in order to do that, you need to be able to make some informed decisions. So if you pass your risk to the subcontractors, and they provide you with a certificate of insurance, it can be a quick win to pass the risk along to the subbie, but equally it can sometimes be a false economy, and so it's important to understand the pros and the cons of that decision, and ultimately, as I say, make an informed decision to make that part of your business strategy, if that's what you want. I'll give you a really good example in the context of this. If that subcontractor falls into liquidation, or that they fail to actually buy the right insurances that would respond to the works that they're undertaking for you as a subcontractor, then ultimately they're not going to be able to fulfill the protection of those risks that you've asked them to do, and you can be left carrying the can for their loss, if you like. So if you're taking that choice of passing the cover through, what you need to then be doing is a due diligence exercise around that risk protection. And what do we mean by that? Well, I guess if they provided you with a certificate, you might want to think, is that really enough? Is that actually evidencing that their coverage is going to operate? Or is it actually just evidencing that they've just bought a policy, whether it operates or not? And I'll give you some classic things that we see all the time where these policies are being bought, but not necessarily being bought properly and being properly considered. We see regularly height limits or hot works exclusions for roofers or scaffolders. It's common to see exclusions for working in, around or adjacent to water. Well, what does that actually mean? I mean, most construction sites will have some form of water within close proximity, even if it's an attenuation pond. So, of course, that can often operate as an exclusion immediately. And another one is if for anybody working in property that's in their care, custody and control. So we could be talking here a fit out project, an extension project, a project that's had partial handovers, and some of that has then become existing property. There might be an exclusion for property in the care, custody and control of that insured party. And suddenly you've effectively got no protection in the event that that building suffers loss or damage as a result of those works. So, those are just a few of the sorts of reasons why we regularly see policies that might have been evidenced to exist, but actually may not be properly operating. And of course, another one is around the professional indemnity cover right now, and people really need to be making sure that they are challenging the coverage and actually asking the right questions, and of course that's where we can help. Nick, did you want to add anything to that at all?
I suppose just to build on what you said, Jason, I think insurance is so in sort of managing supply chain risk, we've got preventative, detective and corrective controls, and by the time you get into insurance, we're looking at something that's already gone, something that's occurred, an issue has materialized. And so I think I think to build on Jason's point, you need to understand what risks that policy is looking to address, and then perhaps think about whether you consider that risk assessment to be sufficient. But that talks to being active in understanding how the risk is being managed by your subcontractor, and making sure that you are comfortable with it, because ultimately, as we say, it's going to materialize with you. The impact will materialize with you. You might get you might be able to recover money, but ultimately still going to cause delay, still going to cause issues. You're still going to spend money rectifying the issue that's materialized. So yeah, that's all I would add to that, Jason. Thanks.
Thank you, Nick.
Thank you both. One for you, Nick. What advice would you give to start implementing a supply management framework?
Yeah, so I would say a couple of things. Whenever I work with business, I always ask who their immediate suppliers are, and often the organisation doesn't really know. I also ask what contracts are in place, and the organisation doesn't know. So I would start there, because contracts and suppliers are a key part of financial management. So I would encourage organisations to make sure that they've got a robust supplier management mechanism set up, and that they're able to trace and archive their contracts properly or effectively, so that they know everything that comes into the company boundary. I'd also then encourage them to, if they haven't got a risk management structure, to start thinking about what risks they are exposed to, and start putting in place people who can advise around risk and how to manage risk. But it's, you know, organisations, FTSE listed organisations I've worked with don't have particularly effective supplier management or risk management framework. So it's not an unusual situation. But yeah, start with the basics and build from there. It's a maturity journey.
Thank you, Nick. One for you, Sally. Can I take out a bond myself, or does this need to be done through the contractor?
Unfortunately not. It would have to be provided by the contractor, because the surety is essentially acting as a guarantor, guaranteeing the obligations of the contractor in favour of you as beneficiary and or employer. So the provision of the bond has to be by the contractor.
Wonderful. Thank you, Sally. Another question here. I always ask the contractor to insure my projects. Am I at risk in the event of contractor insolvency? And what would your advice be to help myself be more protected?
I guess I'll take that one. Yeah, absolutely. You're at risk of insolvency, or at risk of the insolvency element of the contractor, simply because if you pass that risk through to the contractor to protect, then ultimately, if the contractor goes insolvent, their insurance disappears and you are left with a project that is uninsured. I guess what I often try to explain to the owners and employers of projects is that it's their money that's being put at risk. It's their investment, or indeed it could be their financiers' money that's being utilised. But ultimately, if we think about every other asset, every other element of our working lives, our cars, our homes, our business premises, we all insure those ourselves, because we as the owners of those assets are best placed to protect them. So it's quite unusual, in fact, very unusual in the construction sector, that people transact the insurance responsibilities of their owned assets and their multi-million pound assets as well to other parties to insure. It's similar to asking a neighbour to insure your car or your home for you, or being on a business park and asking the company next door to insure your premises for you. It's not the done thing, and it's not the done thing for good reason, because it creates a whole new set of challenges, if you like, around making sure that they've paid premium, checking that the policy is actually fit for purpose, that it's protecting the right assets. But in terms of insolvency, of course, should any of those parties who've put those insurances in place for you disappear, that's it. Those insurances are gone. So the only surefire way for an employer to protect against the risk that their contractor becomes insolvent is actually to take out the policy themselves, as we do in life for all of our assets. And I guess there's a lot of benefits to that as well. Not only does it actually protect everybody on that project, so all of the contractors, all of the subcontractors and parties coming to site, so they've got the peace of mind that there is the protection in place when they come to do those works. It actually means that there's no duplication of premium costs. Nobody's charging premium in that supply chain for the contract, because actually it's being dealt with at the top of that pyramid of contracting. And ultimately, if you're the policy holder and your contractor goes under, well, that project is going to evolve. It's going to change in price. It's going to potentially change in the scope of works. So you've then got the control to go to your insurer and say, this is how my project has evolved. Please, can you update my insurances accordingly? So there's a lot of benefits, if you like. And so my message in that particular instance, where you have traditionally passed those risks through to the contractor and down the supply chain, is that you might want to now rethink that strategy in view of the growing insolvency risk, because of the significance that might have on protecting your assets.
Thank you, Jason. Another one for you, Nick. What trends are we seeing in contract management since the pandemic?
Pandemic, and I know Jason apologised for it, so again, apologies for discussing it. But I think what that brought into focus was the fact that we had created internationally and globally a supply chain that was based on efficiency, that relied on secure transport links and lines of communication, and when that all shut down, it obviously efficiency comes at a risk, and so we sort of veered more towards resilience, which comes at a cost. So I think what we've seen is that there's been a different way of perceiving contract and supply risk from prime contractors, in terms of wanting to get greater assurance that the contractors and the suppliers are delivering what they said when they said. We work with the Houses of Parliament, and they are still going through some issues in terms of trying to confirm whether contractors in the construction sector delivered what they said they were delivered within the confines of the contract. So they are putting a much greater emphasis on scrutinising contracts and the delivery of contracts. But we're also seeing greater willingness to be collaborative. I think in the past we saw sort of butting of heads, adversarial, trying to push the cost down for the supplier, trying to get, not quite a race to the bottom, but getting more for less. And I think what we have seen is a greater willingness to work together to manage the risks, to provide solutions, because it's better if both parties are solvent and operating, isn't it? Than if we have sort of this power differential or situation where one party is struggling, because it affects everyone. And we, as we're seeing now, cost of living crisis, price increases, it's now more important than ever to make sure people are employed, that we're getting value for money, and things like that. So I think, it's changing this from efficiency to resilience, and we might go back there. So onshoring, nearshoring, making sure that we've got buffer stock and ability to cope with shocks, but also a much more collaborative approach, and an increasing, and it's like Monty Python sketch, isn't it? The third thing is the desire to understand what's behind your immediate suppliers and what exposure as we get into sort of more regulation. Modern slavery being a classic example that affects this sector. So hopefully that answers that.
Brilliant. Thanks very much, Nick. And we've got time for one more, and this is towards you, Jason. Please, can you expand on the point about project policies being provided by the employer in joint names, and why that would solve much of the insolvency risk of being uninsured?
Okay, thanks, Vanessa. I guess I've probably to some extent answered this question earlier, but just picking up on the piece around joint names. So joint names is a common requirement in the JCT contract, for example, for the insurances that are required for a project. And what it ultimately means is that each party to that project that's required to be a joint named insured has the protection of that policy as if they were the insured, and they can't recover losses from them because they're all effectively covered under the one policy. So in terms of the context of my discussion around how that adds value to the scenario that we face with the growing insolvency, is that if the employer takes out a policy that is in the joint names of all of the contractors and subcontractors undertaking their works, then should one of those contractors and subcontractors become insolvent and change during the project, the policy continues to operate, and whoever may be appointed in their place as a new contractor or subcontractor, that party will continue also to benefit from this particular policy in joint names when they come to site to undertake those works. So the critical nature of that policy is that it is in joint names of all of the contractors and subcontractors, as well as the employer and their financiers.
Thank you very much, Jason. Thank you, Nick and Sally. And with that, I'll hand back to you, Jason, to close the session off.
Okay, thanks, Vanessa. Well, great set of questions there. So thank you for everybody that's asked some questions today. And I guess we just close with a real summary of the key messages from our webinar today. Firstly, to really consider your risk position as an organisation, and also on each and every project, and how that strategy is consistent and aligns with your business. Make sure that where you are relying on insurances to protect you from particular risks, that those insurances have been assessed to be robust and fit for purpose, and that they're going to operate for you in the way that your business requires. And that you've considered some of the other risks, and we've talked today about the latent defects, potential and solutions there. And thank you as well to Sally for talking us through the bonds and how they protect and provide solutions against insolvency risk, and also to Nick and to BDO for talking through supply chains and the inherent risks in those, and what can be done to help mitigate the insolvency risks there. So thank you to everybody. Have a wonderful day, and I hope that we get to speak again soon. Take care.